My name is Michael Guyette, publisher of the Lead Lag Report. Joining me today is Ritesh Jain, who's got a lot to say about global liquidity, India's markets, and Canada's economy as well. Ritesh, introduce yourself to the audience. Who are you? What's your background? As you got involved, interested in markets, and what are you doing currently?
Thanks, Michael. Actually, in my previous life, basically, which was still 5 years back, I was a chief investment officer for one of the largest, one of the better known names in India, Tata Asset Management, where I used to manage $7 billion under assets under management in both equity, fixed income, and offshore funds, basically offshore funds investing in Indian markets. 5 years back, I decided to move to Canada for personal reasons. Because I have been invested in global macro for a long period of time, in India, you cannot do a lot of global macro. And since India has a closed capital account, basically, you cannot have the same views expressed in India if you have a global views. So when I shifted over here 5 years back, I started investing my own money in a global macro way. And then what happened over a year back, we started our own global asset allocation product known as Pine Tree Macro, which is now $2.5 million of external assets under management. The fund basically invests only in ETFs. I do not have I'm not a bottoms up guy. I'm only a top down guy. I just look at where the liquidity is going. And thankfully, North America has 2,000 listed ETFs, and possibly 500 of them are deep liquid enough that you can easily express your view if you have a view on a particular asset class. So there are times where I don't even know the underlying, the stocks, if it is a stock ETF or, so, but that I don't care because I don't understand the micro part. I only understand the macro part, and it has served me well over a period of time. So apart from running Pine Tree Macro, I'm also a strategic advisor and a board member at Eastern Financials, which is the biggest wealth manager out of East India. They manage $600 million of assets under management, and they have 120,000 customers. Apart from that, I'm also economic advisor to Old Bridge Capital, better known as, run by Kenneth Andrade, who is known as one of the best investors in India. They've just got their, mutual fund license. So it's a very interesting and important time for them. This is all I do actually. Everything boils down from the global macro view, whether you have to take a view on building a business in wealth management, whether you have to look at what sectors will do in India, or whether you have to look at which countries, which assets will do well from a macro perspective. So it's the same study which goes out to all different levels. And, the most underappreciated part of macro is that if you have a great macro view, you can even run good businesses. Okay, but I found it very missing in the fund managers, which I worked in India, because they did not used to take that into account. But over a period of last 4 or 5 years, the acceptance of macro in India has become far important than what it was previously.
And I'm with you, by the way, on that point about most movement is because of the averages, not the individual securities, in the average. I mean, that's well known asset allocation. Brinson B. Bauer Hood, right, is the primary determinant of portfolio returns is, choosing the right average. The thing is, as you know, on Twitter in particular, everyone seemingly thinks that they're a phenomenal macro thinker and analyst when it comes to looking at the globe. Let's get basic and just describe what macro should be versus what people think it is on social media.
Okay, so I'll just give you a recent example. Actually, I had written at the start of the year also, my view for the year, which is there on my LinkedIn and Twitter. But let me give you an example, because example will make it much clearer and easier for people to understand macro. I was going through the Inflation Reduction Act of United States. And then I realized that only the countries which are part of USMCA, basically United States, Canada, and Mexico, will be the beneficiary of US Inflation Reduction Act. And although their US allies wanted a piece of IRA, US decided that they will not be getting a piece of IRA. So then I said, if USMCA is going to be the biggest beneficiary of IRA, which is the country which is going to be bigger beneficiary, whether it is where you have the largest delta, it cannot be Canada. Certainly not. Canada is not a productive country at all. Then I realized that Mexico is going to be the biggest beneficiary of USMCA, where a lot of companies globally will find it much cheaper labor, much demographics which much much more favorable. So they can not only produce in Mexico, but they can produce in Mexico for United States and Canada, and also produce for Mexico. And today, what we are having is a very simple thing. Mexican markets are hitting a new 50. Mexican ETF is hitting a 52-week high. Mexican peso is up 30% in the last 1.5 years versus Canadian dollars. Mexican peso is up 20% again versus US dollars in the last 1 year. And there goes my Mexican vacation, because now Mexican vacation has become very, very costly for me in Canadian dollars. So this is a very simple example of where the money is moving. So many companies have decided to put their manufacturing base in Mexico, and Mexico is one of the biggest winner of this IRA. So where did it all follow from? You just had to look at the big picture. Where was the money flowing? Who was putting? Okay, United States is putting the money. United States is subsidizing a lot of manufacturing. Okay. But where is the manufacturing going? Manufacturing will be going into Mexico. That means huge amount of foreign capital will be flowing into Mexico. Mexico will get liquefied. And if Mexico is going to be a very big beneficiary of inward remittances, okay, then it will lead to Mexican peso also doing well. And obviously, it will rub off in the economy, which will show up into the stock market. And here we are actually, if you look at it in Mexico, the same thing today I'm seeing in Turkey. Turkey is, nobody wants to touch Turkey today. But as soon as they allowed Sweden to become a part of, they were the only stumbling block in NATO, not allowing Sweden to become a part of NATO. So once they suddenly allowed, they changed their view that we will allow Sweden to become a part of NATO. I'm pretty sure behind the scenes, there is a huge financial package, which media has also, kind of in bits and pieces that's been written somewhere. Today, Turkey needs some amount of liquidity to reliquify its economy and get out of the mess of, very high inflation. I believe the Sweden deal is a very simple thing where, Turkey will be getting a very sweetheart deal from IMF or United States in the form of liquefying their economy and getting their economy into the feet. And both Turkish lira and Turkish stock market will be a great winner in the coming months. So these are just two small examples of how to look at macro and how macro is completely different than micro. I have not named a single company out of Mexico. Maybe I'll know Pemex, and who knows? I was just looking at one day, even Walmart Mexico is a part of that index. But honestly, I don't care about it. Even in Turkey, I would not care about, which are the companies in the Turkish stock market. I would be looking at only, Turkish lira and Turkish equities, put both of them put together, and here you have it. And if you want to know, there is one more example which I can give. So one more relevant example was Japan. I was looking at Japan's balance sheet. I was looking at Japan is the only country in G7 which is still allowing inflation to run harder. That means with a yield curve control with inflation harder means only two things. One, your currency will depreciate. Secondly, money will flow from bonds to equities. Okay, so good balance sheets, cheapest stock market. Nobody wants to look at Japan. But if you were to invest in Japan, then whatever money you will make in Japanese equity market, basically Nikkei, then you will lose that money in dollar JPY. So Japan is fortunately having one ETF where they hedges the currency risk on a day-to-day basis. And that ETF is DXJ. I'm just naming it. It is only for example purposes and not just for information purposes. And then there is another ETF, EWJ. EWJ is not currency hedged, whereas DXJ is currency hedged. So that means you will get the upside of Nikkei, but you will not get the downside of investing in yen. Whereas in EWJ, you will get an upside of Nikkei, but you will also get a downside of investing through dollar yen. So here you have it. Two ETFs, both large caps, one currency hedge, one non-currency hedge. The difference of return year to date is 15%. This is not stocks which we are talking about. We are talking about the two biggest ETF outside of Japan. And the difference is 15%. Why? It's currency. So it was a very simple call. Yes, Nikkei will do well because of the policies of Bank of Japan, but yen will not do well. So find something where you participate on the upside in Nikkei, but not get the downside of yen. So this is just three examples, current examples in the last 1 year, which I could think of.
Do you make it a point to always want to hedge out the currency side when you're looking globally, or
No,
are there times when you also want to make a currency bet?
not at all. I do not hedge currency. Japan is is a different animal altogether. And honestly, Japan is the only ETF which has a liquid currency hedged ETF. In emerging markets, you would want to take both the things. Okay, so Japan is the only place where you would want to because of their yield curve control policy. So I would say in the developed world. Whereas in developing countries, as it is, you do not have normal ETFs, liquid ETFs. But even if you have normal liquid ETF, you do not have currency hedged ETFs. So since I invest only in ETF, this was a very great product for me to expose our investors to this particular product.
Yeah, no, and that makes sense. I've noted that before, that emerging markets correlate to their currencies. So where it's developed the inverse aspect of it because of the inflation disinflation dynamics across the two. So I noticed the framework that you have on the website on pinetreemacro.com. You've got this kind of graph axis: inflation bust, inflationary boom, deflationary bust, inflationary boom. Where are we now, given what happened last year? Where are we on that quadrant?
So the growth, the way you're looking at growth stocks, the growth stocks are telling you that you are in deflationary boom because the inflation has come down from 8-9% to now 3% on its way, possibly another 2 months of deflation kind of thing. But beyond that thing, I think we are again going to inflation boom. Why it is inflation boom? Simply because of the policies around the world. Deglobalization is a simple reason. Secondly, underinvestment in commodities. Had it not been for US dumping almost in last 18 months the SPR reserves, then oil prices would have been higher by now, and you would not have seen a deflationary boom. This was for a very short period of time. We moved from inflationary boom to deflationary boom. That's why money moved from, cyclical, basically value to growth. And now if oil prices starts moving up again, then we move from deflationary boom to inflationary boom. When will the inflationary bust comes in? When bond yields get out of hand. And I believe that is closer to 5% in US. At that point of time, you will find that we enter into inflationary bust. Till that point of time, I think we are purely, in my view, we are just transitioning now from growth, basically deflationary boom, to inflationary boom, basically value over the next 2-3 months, or possibly 6 months, till the time oil continues to move higher.
So since I named the space, I want to focus on Indian and Canadian economies. How does that factor into Canada? So we'll talk about Canada first. But I just did a Twitter space, had someone on who referenced what's fairly well known now, which is you have a lot of these mortgages that are going to reset in Canada, and the real estate investors are going to be in big trouble as those resets happen. How do you think about Canada's economy here relative to housing and leverage overall?
So I'll give you basically. I'll just let me summarize some words of which is the article which came in, Globe and Mail, where big six banks basically they control almost the entire market. What percentage of Canadian bank mortgage books had amortization above 35 years in 2002, January 2022? When I was looking at it, it was zero. What percentage of Canadian banks mortgage book has amortization above 35 years in January 2023? Average of 25 to 30%. We are having a problem here in Canada where Bank of Canada believes that consumer is strong, but consumer is strong, it's perceived to be strong because he is not seeing higher mortgage he's not seeing the higher mortgage rates. What he's seen the higher maturity of his existing mortgage, which was earlier possibly 25, 30 years, as I've said. I have myself seen some of the snippets of, those mortgages getting extended 25, 30 years to 70, 80 years in some case, and some of them are not even covering interest also. Now you will say something, let me tell you something about Canadian economy. Canadian economy is a very oligopoly economy where it is most of the, GDP comes from two sectors, basically resource, and the third is resource, and second is construction related activities. Okay. That boom, in my view, got over, but possibly got extended a little bit because of 2.5 million immigrants, which, even though they couldn't buy a house, they could actually rent. They needed a place to rent. Rental yields went up. When rental yields go up, the house prices cannot go down because of the as a percentage which we are looking at it. But Canadian banks thought that Bank of Canada will not be able to raise the rate so much from 0 to 5, 4.5, 5%, and they will possibly stop in between. They don't need to increase the mortgage, pass on the mortgage increase to the borrowers, and hence the defaults have not started. If you look at any of the P2P lending platforms in Canada, also, you will find that defaults have not started simply because people are not seeing higher payouts for their existing mortgages. I believe that time is coming within next 12 months where you will find that more and more of these mortgages increase will be passed on to the customer. And at that point of time, you will have serious defaults being picked up in Canada, which will lead to higher unemployment because huge part of employment is related to construction activities. And as unemployment picks up, at that point of time, Bank of Canada will be faced with a choice in the next 12 months. Either sacrifice, the Canadian real estate and employment situation, or sacrifice the Canadian, currency, basically CAD. Now, there is just one caveat. We export 5 million barrels of oil per day from here, 3.8 million out of Alberta. That's a separate thing that our federal government wants to control the, oil and gas, the supply. They want to reduce over a period of next 7-8 years. They want, that we cap our oil exports. But we have that as a buffer for us if we want to, increase if our federal government allows. If our federal government does not allow, then within next 12 months, we will see a very strong increase in, very high increase in, unemployment going up, construction activity slowing down further, and it will start impacting Canadian dollar in the next 6 to 12 months. And at that point of time, Bank of Canada will have to decide. If you look at it, Australia is also almost the same economy as Canada. In Australia, they shunted their central bank governor, RBI governor. I believe in the next 6 to 12 months, we will have the same situation because they have federal elections coming up. So you cannot have these high rates coming, in the run up to the election and leading to higher unemployment, which will impact the psyche of voters. So there is something coming in next 6 to 12 months, which will massively have a massive move, which will lead to either massive move in either currency, or it will or it will lead to massive move in very high unemployment.
Do you think that would be isolated to Canada, or what's the sort of knock-on effects of that on a global scale?
Nothing. Canada is nothing on global scale. Actually, two luckiest economy in the world are Australia and Canada. Australia is the luckiest economy. Canada is the second luckiest economy. I consider lucky basically the difference between the two recession. Canada and Australia both did not get their global financial crisis recession in 2008-9. Whereas US consumer balance sheet got reset, Indian banking got reset. In Canada and Australia, if there was no, there was no global financial crisis, so they continued building their imbalances, but they're not too big on the global scales. Honestly, nothing matters if what happens in Canada. At some point of time, we will have to reset our balance sheets, reset our consumer balance sheet, and even our banking balance sheets. And I don't think that will have any impact on rest of the world. They're just too small.
Okay, now the other part of this is, of course, India, which I'm a huge fan of from a long-term secular bull case argument, certainly relative to China, although I think China also has a potential, at least trade, should they decide to actually step in and counter some of the deflationary forces. But talk about the state of India's economy and just kind of short, intermediate, long-term. What are some of the considerations?
So before I start that thing, actually, I'm going to draw a lot of things from an article written by Capital Group. Capital Group is one of the very large global investors and a big presence in India. So they've written an article on India. It's a must read for all, listeners over here. Maybe you can just Google it and you will find it. Let me tell you something about India. I was not too bullish on India before COVID hit actually the world. But what happened after COVID was, and increasingly after the COVID, I was very critical of Indian government that why are they not spending money? Unemployment is going up. Why are they not spending money actually? Why the fiscal deficit is not blowing the way it is blowing up in G7 countries? But today, if I look back and I have to eat my words and say my criticism was wrong, I look at what has happened to developed world, I look at what has happened to India. Now, let me give you two numbers over here. As per IMF, I'm just quoting IMF or World Bank, you can quote it. Over the next 2 years, because they can come out with it, at least 1 or 2 years of their projections are good. G7 countries will have a nominal GDP of 3 to 5%. With 120 to 130% debt to GDP. You already know US has a debt to GDP of 130%. Canada has a debt to GDP of 110% to 115%. And if the growth comes down, their debt to GDP will go up. India has a debt to GDP of 90 to 95%. India's nominal GDP, basically inflation plus real GDP over the next 2 years, will be between 12 to 14%. At that rate of nominal GDP, our total debt to GDP will only come down, it will not go up. So India historically has been known as a very soft power. Means nobody gets threatened by India. India doesn't threaten anybody. So it has, and being a democracy, every democracy is like a white elephant. It is like an elephant which moves slowly at its own pace. India has been lucky 2-3 times in the past 50 years, and this is our luck. We are getting one more chance of rebuilding ourselves again. We lost huge amount of jobs, huge amount of industry to China after 2002, when China was scandalously, arrived into WTO because US corporate sector wanted China to be a part of WTO in spite of not being a market economy. India lost huge amount of jobs, like US, any other country. India lost huge amount of jobs to China. But now what is happening is, because China wants to reassert itself, it wants to be a global power for whatever reasons. It has arrived at the scene where it is now we are a kind of soft, Cold War, that everybody is looking at some other, country where they can rebuild their or, reshore their supply chain. And in that place, India is actually comes out to be very good. The way Mexico looks very good in, the North America. When you look at globally, then you find that India looks, very rightly placed for this thing, whether you call it China plus one, whether you look at Middle East looking to reinvest their cash surpluses away from US Treasury into a country where you have a very young population. Stars are getting aligned for India. Now, I must go back and say, if India would have done the same kind of fiscal deficit which Western world did, today our inflation would have been between 15 to 20%. But today our inflation is 6%. US, Canada is around 3 to 4%. So there is not too much of an, inflation differentials. Historically, India's currency has depreciated against Western world simply because of inflation differentials. But today, if I look at beyond 1 or 2 years, I strongly believe, and this is there, which should be reflected in which is reflected in my own investment. I believe that Indian currency will start appreciating against Western world currencies, especially against currencies which have huge amount of debt, debt, whether at household level or whether it is at federal level. So this is one thing on the currency part where currency will start appreciating going forward, which will help. It will not happen, may not happen this year. It will take some time. Okay. But I believe by middle of next year, you will start. I would say that you should be starting getting long on Indian rupee versus developed world currency, especially against Canadian dollar or Australian dollar. It doesn't matter. So on currency part, this is the thing. Secondly, historically, India has actually got its GDP by first, getting job creation in service sector. Now, service sector cannot create that kind of jobs which a manufacturing does it. So India leapfrogged manufacturing and went into services, whereas China did the right way and took all the manufacturing. As per data, I'm not remembering who quoted that data, which is by an authority. Services create only 20% of the jobs which manufacturing can create. Now, India is trying to move from services to manufacturing. And manufacturing, since it's a capital deficient country, it is now having huge amount of capital flow coming from whether it is Middle East, Dubai, Saudi Arabia, or whether it is coming from Japan, which is a long-term partner of India, or whether it is coming from US, where you had, the Apple CEO going to India a few months back. Now, I'll give you a small example of how good India's electronics have become. Till 5 years back, we used to make only refurbished phones in India. That too, iPhone 5 or iPhone 6, we used to make refurbished phones. Apple just put one facility over there. Today, last year, when iPhone 14 came, was introduced in China, was introduced. Obviously, it was made in China. But within 3 months of making in China, Apple iPhone actually came out of factories from India also. So India in electronics, can you see over the last 5 years has moved from making refurbished phones to making Apple iPhone 14. You're talking about manufacturing services. Everybody knows that India is very good at services, which is reflected in our benchmarks also. But going forward, it is the manufacturing, because what we are missing today is jobs. We are having a jobless recovery, and nothing can create jobs as much as manufacturing. Huge amount of foreign capital, whether it is coming from Middle East, whether it is coming from Japan, or whether it is coming from China, who wants to invest in India also. But we are obviously, because of some reason, we do not want a lot of Chinese investment. Whether it is coming from Europe or whether it is coming from US, India will be one of the bigger beneficiaries of having huge amount of manufacturing being put into India, which will lead to higher, employment. Employment is the necessary conditions for India to leapfrog to the next level in this decade. I am seeing all the basic things being put, basic, basic arguments. What I've put over here, in my view, will lead to is just the bits and pieces which I'm picking up from a lot of different places, a lot of different conversations which are happening. And I think since I'm a global macro guy, I do not look at beyond that things. This will lead to, in my view, a decade for India, which will, and obviously that should be reflected in the higher equity returns. And if currency also starts appreciating, this will start, you will start looking at returns both in the currency and, the equity returns also in India. So this is just a basic thing which I have put together for India.
Presumably part of that manufacturing push is infrastructure spend is going to be a big part of that.
Yeah.
I think a lot of people in the West think about, just how much needs to be built out in India as far as just basic infrastructure. But what's sort of the state of infrastructure in the country currently, and any sort of momentum that might be picking up there?
So there are a lot of new infrastructure projects which are being getting implemented in India. Please understand that being a part of democracy means you need to get tick marks, approvals from each and everybody. Okay, and it takes time for all those things to happen. But the most underrated minister, in my view, in India's ministry is actually the person who looks at the infrastructure. It is Mr. Nitin Gadkari, and the amount of work which he's done over the last few years by staying in shadow is humongous. You can look at the kind of the big Delhi Bombay. Just spend some time. There will be some enough videos of what is happening on Delhi Bombay highway. Okay, I would have never thought that we will have these kind of highways being put up in India. India today is having the second highest amount of road network in the world after China, already being put in. And all this work started happening 10 years back, actually. Sorry, 7-8 years back, I think, because it took some 2-3 years for getting into the groove, buying lands, putting all these, getting all the approvals from all the authorities, and then you start, building up roads and all. So all this thing, I think, by the time we have the next election, we will be able to showcase, some of these big infrastructure projects which are being put in India. Yes, we are also facing some of our problems where we do some of these works which we do is very shoddy work, and unfortunately that shoddy work which is not done properly is the only one which is getting reflected in social media or anywhere else, but not the great work which is being done on a lot of highways, a lot of building projects which are being done in India. Now, I'm not remembering offhand which are being these ones, but I would reference anybody to look at the amount of infrastructure projects being put in. You can read that article in that Capital Group article.
I see in the Twitter thread here, so person asking if you expect the rupee to start appreciating against the dollar or Canadian dollars. It makes sense to hold gold in rupees. Gold's obviously portion of the way that people in India. Any thoughts on sort of the idea of holding gold in rupees?
So if rupee starts appreciating, let's say, I do not expect the rupee to appreciate by 10-15% kind of thing. What I'm saying is, first we will stop our depreciation of rupee. We don't need to accumulate now $600 billion of FX reserves. If incrementally we can buy our oil in UAE dirham, we don't want to pay Chinese yuan, but incrementally if you want to pay in UAE dirham, if my currency does not depreciate. So historically, Indian rupee has, gold has given a return of 14%, 2000 till date, on an average for last 22 years. And almost 3 to 4% of that return on an average has come out of currency depreciation. Also, add currency depreciation to a gold return and you had a 14% returns. If my currency is not going to depreciate going forward, but gold is increasingly being accepted into the system, then yes, gold will continue to go up in Indian rupee, but you will not get the benefit of, Indian rupee depreciations against US dollar, which used to give us extra 3-4% return of, gold in Indian rupee. So I would say that yes, gold will go up in Indian rupee, but not to that extent, simply because the currency depreciation against Western world will not be there. Now, I strongly believe that US is putting a lot of building blocks. They want to get their manufacturing back. And you can see that thing with the amount of, the spending they are doing on putting factories. So I'm more upbeat on US dollar than Canadian dollar. That means rupee should appreciate over a long period of time, should appreciate more against Canadian dollar than against US dollar. But when I say more, I am not talking about 10 to 15% appreciation. I'm just saying first it will stop depreciating, and over the next period of 3-4 years, you will have possibly a 1 to 2% appreciation going forward for the next few years.
What about sort of where to target when it comes to India's stock market? So I get the average asset allocation framework, but it's a usual truism that smaller cap companies in a country tend to be more domestic consumer sensitive than larger cap, which tends to be more multinational. Are there some parts of the India stock market that, just from a market cap perspective, look more interesting?
So whenever you have high inflation, even high means whenever you have 5-6% inflation, in a capacity constrained economy like India, the money spills over into mid caps and small caps. You are seeing currently that a 12 to 13% nominal GDP will lead to more money being put into small caps and mid caps. Large caps, in my view, are for institutional investors. They are not for an average investor. So if you're an institutional investor looking to invest in India first time, or maybe, getting your feet wet, yes, there are some of them which understand India and they have gone from large cap to mid cap and small caps. There are some in India, institutional investors, which have stayed with large caps only. But incrementally, but a 5 to 6% inflation means that more mid cap and small cap companies will start doing better than the large cap companies. Plus, the way government of India is spending money, that roughly again means in certain specific sectors, which is happening in rest of the world also, where governments are becoming powerful and driving a particular sectoral growth, or some other sectors where depriving of credit. So wherever they are putting credit, where they are pushing for those things, whether it is green and clean energy transition, you will have new winners coming out of those sectors. Now, never ask PE of India. Actually, India has historically been a very, very expensive market. It has not remained cheap for a long period of time. In fact, I have a data that anytime it has gone one standard deviation below mean, basically 15 to 6, one standard deviation below mean, then it has not stayed there even for 30 days. So you will always find India, unfortunately, you have to always buy costly. And if you wait for cheap, then you will certainly not get cheap for a long period of time. I would say small and mid cap for a 12 to 14% nominal GDP economy will do better than a large cap.
What about risks when it comes to food price volatility, right? Which we're starting to see a little bit starting again with wheat prices and corn. But yeah, how do food prices, ag prices factor into India's economy?
So there are clearly two risks in Indian economy, and both the two risks are basically oil, and the second layer is soft commodity prices. In Western world, people pay somewhere between 10 to 12% on their daily necessities. India, because of the average per capita GDP, they pay between 40 to 50% for their daily necessities. So if so these are the two risks I would say that exist for India. We have actually reduced the risk of oil prices to a large extent. But for us, even 80 to 100 is a sweet spot for India to accommodate the oil prices. But soft commodity prices rising, the way you've seen in the last few days, if it continues for some more weeks kind of thing, then yes, I would say that it will have the kind of clear and present danger which RBI will not hesitate and will go for increasing the rates. So so this is a caveat which you will always find for India. Over the last 1 year, India has done well also simply because oil prices have been kept in a range which has allowed inflation to come down exactly like US.
Presumably, India has done some moves to try to make it, to use a Nassim Taleb type term, anti-fragile, more anti-fragile to what's gone on with food price volatility with Russia entering Ukraine. What other sort of exogenous shocks could hurt India's economy?
Actually, these days, exogenous shock can come from anywhere else, but everything
Yeah,
will
exactly.
everything will come out in the form of oil prices moving up, and that is my biggest worry. The amount of underinvestment I am seeing it, globally since 2017 in oil and gas makes me, very nervous on the way, oil prices can move in the next coming 2 3 years. And this, apart from, as I say, the soft commodities are the biggest risk. But yes, around us, India is not even having friendly neighbors around it, can lead to more defense spending. But that is always a part and parcel of any country, defending its borders. Then people keep on talking about China, Taiwan. But in the short term, it might be a dampener for India. But India will be one of the biggest winners for if anything happens on China, Taiwan, with more and more, more and more capital moving from South Korea and Taiwan and Japan to India. So oil is the biggest risk for India's economy. External risk. Internal risk is that our policies should continue in spite of whichever party is in the power. I have looked at the amount of now I'm not having the specific data as of now, but I have looked at how much Indian money is invested in stock market. Indian residents' money is invested in stock market. How much is invested in gold, real estate, and I find that we are at 1/3 level of developed world. So that part is debatable. Although some of the rich money keeps on moving out of India for different purposes, but I strongly believe that Indians are still not invested in their own economy, through stock market. In fact, I'll give you some other example also where, even NRIs. I wish I could be having data at the tip as of now, but increasingly over the last few years, NRIs have invested in India's real estate for the simple reason currency used to depreciate. And if currency used to depreciate, real assets always used to give better return than stock markets for foreign investors. So even NRIs used to invest more in India's real estate than in India's stock market. If my currency is not going to depreciate beyond next 12 to 18 months, then increasingly NRIs will also shift from investing from real estate into India's stock market. So I do not believe that Indians are overexposed to their own stock market. Actually, they are more overexposed to gold and fixed deposits, and historically, we know the reason for that.
So what I'm hearing from you is that it's not like you have a culture of stock investing among the vast majority of people in India. Like in Brazil, there's a very strong community that they may not have a lot of money, but they put money to work in Brazil's stock market. You don't have the same dynamics within India.
No, and we have started in the last 5 years only. I've looked at the number of demat account. I don't remember. It's a 4 crore, basically 40 million demat account which we have. Now, some people say that we do not have, those kind of incomes, but we are 1.3 billion people. I think 40 million is the demat account which I have. 40, and now it might be 50 million demat accounts. And the amount of gold which Indians have, 22,000 tons of gold which we have at. And historically, if you continue to do well in an asset class, you don't move from that asset class to some other asset class. Gold has given a 14% return in Indian rupee. on an average over the last 22 years. Real estate in second tier cities have done very, very well. So there are assets which have competed with equities on return with less volatility. So it's just that the new over the last 4 or 5 years is when we have started investing more in equities, started thinking about retirement planning, and after COVID, obviously because of the fintech boom, and you have those kind of new age brokers that just started it. I think it's just a start, and I'll give you a small example. Uh, for over the last 2 3 years, uh, asset managers have stagnated. The stock prices of asset managers have stagnated, but the stock prices of wealth managers are at an all-time high. They are hitting an all-time high. They are getting now more and more customers. You talk to wealth managers, you listen to their call calls. You have more and more wealth managers are seeing more and more customers coming with them to put it into financial products, including obviously into equities and private equity. And as you know, Indians have been savers. Although the saving rates have gone down, but we have been historically been a savers. So I believe that on every big dip, you will have Indian savers coming in to support this market. And you can look at systematic investment plan. How much is the systematic investment plan grown over the last 4 or 5 years? Now, corporate profitability is a function of nominal GDP. It is never a function of real GDP or inflation. It's a combination of both the things. India will, at least for the next 2 3 years, will have a nominal GDP which is more than double of Western world, including United States. So eventually, you are right. If we start becoming a mature nation, markets start becoming more mature. And at that point of time, you will have that multiple D rating. Profits continue to move up, but you will have multiple D rating.
I feel like if we're going to talk macro, we should be talking about the thing that drives everything, which is the cost of capital. Obviously, we focus on interest rates in the States, but talk about India and their financing credit market. First of all, just in general, is it? I have to assume it's obviously nowhere near as large as the U.S., but has there been an increased financialization that allows for easier access to capital among entrepreneurs in India? We'll talk about just sort of the state of the credit market.
Yeah. So at individual level, the credit scoring. So India's fintech boom and India's digitization is far, far ahead of Western world. You can look at in the UPI payments also, which is happening. Okay. Everybody is having a credit score simply because you are having an Aadhaar card. So which allows, the more digital footprint you have, the more credit history you make, which allows fintech companies to give you, price your credit accordingly. And there's huge amount of capital being flowing into fintech companies, which is vying for the shares from consumers. And the downside of that thing, that consumer loan as a percentage of GDP has gone up, but it is still 1/3 of what it is in Canada. Canada is 110%. I think India is closer to 40%. All because of digitization, Aadhaar, everybody having an Aadhaar, bank account, digital footprints. You are creating a repository where all these people are going to be, their credit scores is available for the lenders to price the credit accordingly. And now you have different kind of funds which have come into private funds which have come, which invest in which are specialized for small and medium sector enterprises. So even they are also getting huge amount. They are also getting amount of credit which they earlier never used to get from the banking. Banking used to be a lazy banking in India kind of thing. Now you are having this thing being bridged by the investment funds, the fintech companies, to those people who were earlier not getting credit or were getting credit at much higher rate than what they should be getting. Now I'll just allude you to a very simple transaction which has happened in India, which is Shapurji Palunji. Basically, they just raised some money from some 15,000 crores. Okay. It's a high yield bond. I have never seen a high yield bond in India very properly structured. When I talked to the global investor, they said it was a very good structuring which was done. A lot of foreign investors came in to buy that high yield bond. Maybe he was not getting money from banks, but he had huge amount of foreign capital, possibly closer to $2 billion, which came into India to buy this high yield bond at 16-17%, giving India a fillip in high yield bond industry, which was not getting that fillip. So now you're having everybody actually is having, because of credit score, because of digitization, because of private funds, the access to credit for an individual has become much, much better. India is now even having a P2P platform. There are 4 or 5 good P2P platforms where you can borrow money like Western world and even lend your money. Most people don't even know. They're still in fixed deposits, whereas at P2P platforms, you can easily lend your money in 12 to 14% like Western world. So India has actually leapfrogged a lot of, on the digitization, which is underappreciated in big part of the world, but global investors do understand that thing.
Ritesh, for those who want to track more your thoughts, where would you point them to?
They can follow me on LinkedIn and Twitter. I put everything on LinkedIn and
And
Twitter, and I write every week on for Pine Tree Macro, so they can just subscribe to on Pine Tree Macro. And every week I send charts and read of the week, podcast of the week. I just send it across.
everybody, please make sure you follow Ritesh. I'm going to wrap this up here since I have another Twitter space coming up shortly. And thank you, everybody, for joining. Thank you, Ritesh. Really do appreciate it.
Thank you, Michael. Thank you, everybody, for listening.